Welcome to the Deep Dive, where we cut through the noise and get straight to the insights that matter. You might think financial markets are all about predictable rules, like the fundamental idea that higher risk should always lead to higher returns.
Yeah, that's kind of Finance 101, right?
Exactly. It's a cornerstone concept.
Mm.
But if you've spent any time at all looking beneath the surface, you'll quickly realize the financial world is actually full of stubborn, head-scratching puzzles.
Oh, absolutely. Places where the elegant theories just don't seem to quite mesh with reality.
Precisely. These are the places where reality just doesn't quite match the elegant theories we hold so dear. Today, we're not just dipping our toes in. We are diving deep into some of the biggest, most enduring conundrums in asset pricing and what a recent breakthrough in financial economics has to say about them.
Sounds fascinating. There are definitely a few persistent mysteries out there.
We're going to really unpack three core mysteries that have long baffled financial researchers and left even seasoned professionals scratching their heads. First up, we have the persistent value premium puzzle, where certain types of stocks seem to consistently outperform others.
Uh-huh. Without an obvious risk explanation, at least within the standard frameworks.
Right. They will tackle the confounding beta anomaly, a perplexing observation where, contrary to what theory tells us, higher market risk doesn't always seem to be rewarded with higher returns.
Yeah, that one's really weird. Sometimes it looks like it's even penalized.
Exactly. And finally, we'll delve into the long-standing failure of the consumption CAPM, a model that is beautifully elegant in theory,
Oh, it's gorgeous theoretically.
but has struggled mightily when you actually, kick the tires against real-world data.
Yeah, the empirical side has been
Yeah.
challenging.
Our mission today, you see, is to explore a fascinating new perspective, a fresh lens offered by a groundbreaking 2019 Journal of Financial Economics paper. It's titled "The CAPM Strikes Back: An Equilibrium Model with Disasters," authored by Bai, Hu, Kung, Li, and Zhang.
Ah, yes. That's a really interesting piece of work. Tackles these issues head on.
It really does. And this isn't just another academic paper. It's a rigorous piece of research that suggests something truly profound, that rare but severe economic disasters might just hold the overlooked key to understanding these long-standing puzzles.
The idea being that maybe these extreme rare events are more important than we thought.
Exactly. And here's the kicker. It does this not by proving our foundational theories like CAPM wrong, but by highlighting where our empirical tests, how we apply those theories to data, might simply fall short.
That's a subtle but really important distinction. It's not the theory that's broken, maybe it's how we're measuring things.
Precisely. It's a subtle but incredibly powerful distinction. So get ready. This is your shortcut to being genuinely well-informed on some pretty complex financial concepts.
We'll try to keep the jargon manageable.
We will. We're going to serve up surprising facts and insights that we think will fundamentally change how you think about risk and return in the market, all delivered with just enough humor and without feeling overwhelmed by the jargon. Consider this your intellectual survival guide for understanding market anomalies. Let's do this.
Let's dive in.
Okay, let's unpack this value premium puzzle first. It's a term often thrown around in financial circles. But what exactly is the value premium, and why has it become such a stubborn enigma for so long? Can you maybe start by defining what we mean by value firms and growth firms in this context?
Absolutely. The intriguing aspect, and really the starting point of this puzzle, is the historical observation that firms with high book-to-market ratios.
Okay, so book value is a high relative to market price. Kind of suggests the market might be undervaluing them.
Exactly. That's the intuition. The value of their assets recorded on the company's books is significantly higher than their market capitalization. These are what we affectionately call value firms.
Okay.
Now, these value firms have, for a very long time, tended to earn consistently higher average stock returns than their counterparts with low book-to-market ratios.
Which we call growth firms. Market price is high relative to book value. Lots of optimism baked in.
Precisely. Growth firms are often seen as having high future potential, so their market price far exceeds their current book value, implying investors have high hopes for their future earnings. Now, the capital asset pricing model, or CAPM,
Cornerstone theory.
yeah, a cornerstone theory in finance, practically Finance 101, struggles immensely to explain this difference. The CAPM posits that if two assets have similar market risk, meaning similar beta or sensitivity to overall market movements.
They should have similar returns, right?
They should theoretically offer similar returns. But for decades, value stocks seemed to defy this. They appeared to perform better without having a proportionally higher market risk, according to CAPM, and that's the core of the puzzle.
It's like finding a free lunch where theory says there shouldn't be one.
Kind of. It's like finding a perpetual motion machine in a world that says energy must be conserved. It just felt wrong, according to the standard model.
And this isn't just some dusty old academic debate confined to economic history, right? This shows up in more recent data, too.
Oh, definitely. When we look at the more recent sample period from July 1963 to June 2017, that's a substantial 648-month window of contemporary market data. The picture is very clear.
Okay.
A portfolio that's strategically constructed by going long in those high book-to-market value stocks and simultaneously short in the low book-to-market growth stocks, what researchers refer to as the value minus growth decile.
So you're getting on value and against growth.
Exactly. That portfolio actually earned a significant average of 0.47% per month.
Wow. It's pretty consistent and notable edge month after month for decades.
It is. But this is where it gets really interesting and, frankly, a bit confounding for traditional theory. Despite that substantial average return of more 0.47% per month, the market beta for this value minus growth portfolio was incredibly low. We're talking a mere 0.07. Practically no market risk, according to the standard measure.
So high returns, almost zero measured market risk.
Bingo. This tiny beta left a large alpha. That's the return the CAPM couldn't explain. The excess return beyond what CAPM would predict for its level of market risk of 0.43% per month.
Almost the entire premium was unexplained alpha.
Pretty much. To put it in simpler terms, if CAPM were right, this portfolio should have had hardly any extra return given its minimal market risk. But it did, and the regressions are squared value.
Which tells us how much market risk explains the return variation.
Right. It was effectively zero, like nada. This indicates that market risk explained virtually none of the value premium in this modern era.
Okay, so CPM looks pretty broken here.
Empirically, yeah. Furthermore, the Givens-GR's test, a standard, robust statistical check. It basically tests if the unexplained parts of returns are jointly zero across a set of assets.
Does the model work overall?
Exactly. That test strongly rejects the hypothesis that the CAPM alphas are jointly zero. In essence, it statistically confirms CAPM just isn't cutting it for the value premium in this specific period, post-1963.
It's like having a perfectly tuned instrument that's supposed to play a certain note, but the sound coming out is completely different consistently.
That's a great analogy. The model just wasn't capturing the reality of value stocks in that time frame.
But hold on, because here's where the narrative takes a fascinating turn. And it suggests we might be looking at the wrong part of the picture, or maybe too narrow a window. What happens if we go back further?
Right. If we extend that sample period much further back in time, all the way to July 1926, a period that notably includes truly cataclysmic economic disruptions like the Great Depression.
Okay, so now we're including some really extreme market events.
Exactly. The story shifts dramatically. Over this full 1092-month sample from July 1926 to June 2017, the average value premium itself actually remains quite similar, still coming in at a robust 0.48% per month.
So the premium isn't disappearing. It's stubbornly there. It's still about 0.5% a month.
Correct. The premium persists. But what becomes strikingly different is the market beta for that same value minus growth portfolio.
Ah, the measured risk.
Yes. It jumps significantly from that tiny 0.07 in the post-1963 period all the way up to 0.45 over the longer disaster-inclusive period.
Whoa, that's a huge jump from almost zero to nearly half the market's risk.
It is. And this much higher beta means the CAPM can explain a substantially larger portion of the value premium, effectively reducing the unexplained alpha to a smaller 0.19%.
Okay, so still some alpha, but much less than before.
Much less. And the regressions R-squared also rises considerably, from effectively zero to a more respectable 14%.
So CAPM is explaining some of the variation now.
Exactly. While the CAPM might not perfectly fit all deciles, its performance in explaining the value premium improves markedly in samples that include these rare, severe economic events.
And what if you look only at the early period, the pre-1963 data?
What's truly illuminating is if you isolate just the pre-1963 sample, which is heavy with those extreme events like the Depression, The market beta for the value minus growth decile rises even further to a robust 0.71.
Even higher beta.
Yeah, and get this, the CAPM alpha actually becomes a negative 0.1%.
Negative alpha,
Yeah.
meaning CAPM overpredicted the return given the risk.
Essentially, yes, or it explained it all away. And the R-squared jumps to 31%. Crucially, for this pre-1963 period, the GRS test fails to reject the CAPM.
So the model that looks broken suddenly looks okay, or at least much better when those big crises are in the data.
Exactly. It's almost as if the CAPM was taking a vacation for a few decades and then came back to work when the market got truly volatile, revealing its true nature.
That's a profound difference.
Yeah.
So what truly stands out to you about why these two time periods, one relatively calm, one with major disasters, tell such different stories about the CAPM's explanatory power? It's the same theory, the same premium.
An important insight here is that the key lies in what the paper calls disaster events. These are periods of extreme, often synchronized market swings.
Like market crashes and sharp recoveries.
Precisely. The research highlights a truly eye-opening statistic. Out of 32 observations with monthly market excess returns below the 1.5th or above the 98.5th percentile from 1926 to 2017, so the really extreme months, a remarkable 23 of those occurred during the Great Depression.
Wow. Almost 3/4 of the biggest swings in nearly a century happened in that one short, intense period.
Think about that impact. During these extreme market movements, the value minus growth return showed a strong correlation of 0.72 with overall market excess returns.
So when the market tanked or soared, value stocks did too, even more so sometimes.
Yeah, they move together strongly. Let's make this concrete. In July 1932, the market excess returns surged by 33.84%, a huge up month.
Right.
And the value minus growth return followed suit, surging an astonishing 44.54%.
Even bigger.
Conversely, in March 1938, the market plunged a brutal negative 3.82%. And the value minus growth return plummeted right alongside it, falling negative 20.35%. This dramatic, synchronized movement is absolutely critical.
So what does this all mean for how those extreme events tilt the CAPM regression line? Can you help us understand how these dramatic, correlated swings fundamentally alter our perception of the relationship between value stocks and the overall market, especially when comparing the two time periods?
You got it. It's like the outliers aren't just noise. They're the signal revealing the true underlying relationship, right?
Seems like it.
Exactly. These dramatic correlated swings, which were largely absent in the post-1963 data, effectively tilt the CAPM regression line. When you include these powerful synchronized movements, those extreme data points pull the regression line strongly.
Like gravity wells for the data point.
Kind of, yeah. It creates a much stronger observed relationship between value stocks and the overall market in the regression. This makes it appear that value stocks have a significantly higher market beta when these disasters are included.
Because they really did move with the market in those extreme times.
Yes. Without them, as we saw in the post-1963 data, that relationship looks largely flat, maybe even random. The line doesn't have those strong anchor points, and so the CAPM appears to fail completely in explaining the value premium.
It's like trying to draw a straight line through a few scattered points versus a line through points that are clearly defined by extreme correlated events.
Perfect analogy. The outliers in this case aren't just noise that you should dismiss. They are the crucial signal that reveals the true underlying, possibly nonlinear relationship between value stocks and market risk.
So the CAPM isn't inherently wrong, maybe, but our application of it in calm periods, without those defining extreme events, simply lacks the data points to reveal the true underlying risk premium.
That's the core argument. It's almost as if the true risk is only revealed in crisis.
Okay, let's move on. Beyond the value premium, another persistent puzzle in asset pricing is known as the beta anomaly. In theory, if you take on more systematic risk, that is, if your asset has a higher market beta, making it more sensitive to overall market movements, you should be compensated for it, right?
Absolutely. Higher risk, higher expected return. That's the bedrock principle.
It's a pretty fundamental, almost intuitive concept. Yet, empirical evidence, when looking across many different stocks, often shows a surprisingly flat or even negative relationship between a stock's market beta and its average return.
Yeah, it's bizarre. You sort stocks by their beta, and the high beta ones don't consistently earn more than the low beta ones. Sometimes they earn less.
It's like the market isn't bothering to reward the extra risk you're taking, or worse, penalizing you for it.
A crucial point here is, why does the market not consistently reward higher beta? The paper points out that in the post-July 1963 sample, if you sort NYSE, Amex, and NASDAQ stocks into deciles based on their pre-ranking market betas calculated using prior 60-month rolling windows.
So using historical data to estimate risk.
Right, the standard approach. The average excess return barely budges from the low beta to high beta deciles. We're talking only a tiny 0.03% spread per month.
Practically nothing. Flat as a pancake.
Pretty much. Despite an economically large post-ranking beta spread of 1.06 between the extreme deciles, meaning there was a genuine difference in the estimated risk.
So the sorting worked. The high data stocks did have higher measured betas later on.
Yes, they did. But the CAPM alpha for the high minus low beta decile was a significant -0.52% per month.
Negative alpha again.
Well,
Meaning high beta stocks actually underperformed their expected returns according to CAPM.
exactly. This isn't just a flat line, it's downward sloping in terms of risk-adjusted returns. Even over the full sample from July 1928, including those disaster periods, the low beta to high beta spread in average return is only 0.16% per month. Still pretty flat, with a statistically significant negative alpha of -0.55%. So the data consistently shows this empirical flatness or even a penalty for higher beta, which is profoundly at odds with what the CAPM predicts should be a clear, upward-sloping line.
Okay, let's unpack this a bit more deeply. Is the TPM simply wrong in its prediction about risk and return, suggesting its core premise is flawed, or like with the value premium? Could there be a fundamental problem with how we're actually measuring that risk in the first place?
That's the million-dollar question, isn't it? And the crux of the matter, as the model meticulously suggests, is that the empirically estimated market beta is often a very poor proxy for the true underlying beta that truly drives risk and return.
Ah, the measurement issue again.
Exactly. We typically estimate beta using historical rolling windows, for example, the prior 60 months or 5 years. This rolling beta essentially captures an average beta over the past 5 years.
Right, looking backward.
But the true beta of a firm, which accurately reflects its real-time exposure to dynamic aggregate and firm-specific state variables, how sensitive it truly is to economic shifts in the present moment, can change much more rapidly and frequently.
So the world moves faster than our 5-year average.
Pretty much. The economic world isn't static, and neither are firms' true risk profiles. Imagine trying to capture the precise speed and direction of a Formula One race car by looking at its average speed over the entire previous race.
Yeah, that wouldn't tell you much about its speed right now.
It simply wouldn't give you the granular, real-time picture you need.
Yeah.
That's potentially what's happening with rolling betas.
So this means the beta we calculate from readily available historical data, that 60-month rolling window, might not accurately reflect the actual moment-by-moment level of systematic risk an investor is truly bearing. It's like using a blurry snapshot from 5 years ago.
Exactly. Or trying to predict the weather today based solely on last month's averages. We're setting ourselves up for misinterpretations.
Okay.
Precisely. In the model simulations, the true beta often exhibits significant mean reversion within a given rolling window.
Meaning it goes up and down, back towards an average.
Yeah, it's not a fixed number. It moves around. This dynamic behavior can lead to a weak or even negative correlation with the more static, backward-looking rolling beta.
So the measured beta and the true beta might not even move together reliably.
That's what the model suggests. The paper shows this correlation to be only weakly positive at 2.84% in disaster samples, but even weakly negative at -5.43% in no disaster samples.
Oh, negative correlation in normal times.
Yeah. This fundamental discrepancy is especially pronounced in periods without realized disasters, where the market is less volatile and the nuances of true beta are harder to capture accurately with historical averages.
Makes sense. The noise might dominate the signal.
Exactly. Even when disasters do occur, improving the alignment somewhat, the measurement errors in these estimated betas remain large and persistent. This inherent noise or imprecision in the empirically observed beta can therefore completely obscure the true positive relationship between systematic risk and expected return.
So the true relationship might be upward sloping, like theory says.
The model generates that, yes.
But the noise in our measurement makes it look flat or even downward sloping when we test it.
That's the argument. It makes the observed beta-return relationship appear flat or even anomalous in cross-sectional tests, even though the underlying economic theory of risk-reward holds true in the model. It's a powerful argument that our tools for measuring risk might be too blunt, too slow, and too linear for the job of capturing dynamic, true risk.
So again, maybe the problem isn't necessarily the CPM's core logic, but our empirical methodology.
That's certainly the perspective this paper puts forward. It's a mismeasurement story, fundamentally.
All right, let's move to our third puzzle. Many financial economists argue that a more fundamental determinant of an asset's expected return isn't just how it co-varies with overall market returns, but rather how it co-varies with consumption growth.
Right, the Consumption Capital Asset Pricing Model, or CCA.
This is the core idea behind the CCAPM. It sounds incredibly intuitive and elegant, linking asset prices directly to how they affect our ability to consume, our well-being.
The theoretical appeal is indeed quite elegant. Think about it this way. Imagine an asset that tends to pay off precisely when you're already experiencing high consumption growth, meaning your income is flowing, you're relatively rich, and you don't desperately need extra income.
Okay.
Such an asset provides less valuable consumption insurance because it's not there to help you when times are tough or your consumption drops. Therefore, it should offer lower expected returns.
Because it doesn't help smooth things out.
Exactly. Conversely, an asset that pays off when you're experiencing low consumption growth when you're relatively poor, perhaps in a recession and every dollar counts, offers incredibly valuable insurance. This disaster hedge provides crucial stability when your consumption is most squeezed, and thus should command a higher expected return in normal times.
The logic is compelling. Grounding asset prices not just in market risk, but in how they ultimately help smooth an investor's consumption over their lifetime. It connects directly to our deepest economic needs.
It really does. It feels more fundamental than just market returns.
Yet, despite this elegant and intuitive theory, empirically, the standard linearized CCAPM often performs quite poorly in tests. Is that right?
Unfortunately, yes. The paper rigorously examined this using two-stage Fama-Macbeth regressions with 25 size and book-to-market portfolios as test assets, a standard approach in finance.
Okay, so they put it through its paces.
They did. With annual consumption growth data from 1930 to 2016, the first-stage regressions for consumption betas, measuring how sensitive each portfolio's return is to consumption changes, often showed them to be insignificant and sometimes even negative for many portfolios. This is baffling.
Wait, negative consumption betas? That would mean the asset does worse when consumption is low? That seems counterintuitive for a risky asset.
It does. For example, the small value portfolio, which historically had a high average annual excess return of 18.56%, a huge return, surprisingly had a lower consumption beta of 1.58 than the small growth portfolio, which only earned 6.04% but had a consumption beta of 2.8.
That's completely backward. The high-return asset has less measured consumption risk, according to the standard test.
Exactly. A complete flip of what the elegant theory would predict. Small value should be riskier in consumption terms to justify that massive return, but the standard measure says it's safer than small growth.
Wow. Okay.
This brings us to a crucial question. Why this persistent apparent misalignment between theory and empirical observation? In the second stage cross-sectional regressions, the estimated price of consumption risk, denoted as buy one, FI one.
How much extra return do you get for bearing consumption risk?
Right. That price was economically very small, only 0.58% per annum, and statistically insignificant.
So investors didn't seem to demand much compensation for this type of risk, according to the test.
Empirically, it looked that way. In stark contrast, the intercept, PEV, A0, the part of the return the model couldn't explain, was economically large, a hefty 10.97%, and highly significant. This implied that a substantial portion of average returns, nearly 11% annually, was left completely unexplained by consumption risk.
It's like saying, we can only explain a tiny fraction of what's going on here.
Pretty much. And the chi-squared test, a rigorous statistical test measuring the overall model fit.
How well does it match the data?
It strongly rejected the consumption CAPM, showing a significant and fundamental mismatch. And the cross-sectional R-squared, indicating the model's explanatory power, was a meager 2.13%.
So basically, almost no explanatory power at all.
Very little. Whether you look at annual or quarterly data, the standard CCAPM just doesn't seem to hold up empirically, leaving a huge chunk of average returns unaccounted for.
The model also looked at another well-known stylized fact in finance. The value premium is typically stronger in small firms compared to large ones, right?
Correct. In the data, the smallest quintile showed a substantial annual value minus growth premium of 12.52%, while the biggest quintile only saw 4.12%. So small value stocks truly shine as a phenomenon.
And did the consumption betas line up with that pattern?
What truly stands out here is that the consumption betas estimated from standard aggregate consumption growth did not align well with this pattern either. They often moved in the wrong direction for value versus growth within different size quintiles.
So, again, the opposite of what you'd expect if consumption risk was driving the premium.
Exactly. It further highlighted the empirical challenges faced by the standard CCAPM. It just couldn't capture these granular details of market behavior, particularly the nuanced risk exposure that differentiates small value from small growth, or even large value from large growth. The model, as empirically tested, seemed to miss the micro foundations driving these premiums.
There's one variant of the CCAPM, though, that seemed to do a bit better. Something about the fourth quarter.
Ah, yes. Popularized by Jagannathan and Wang in 2007, the idea of using only fourth quarter consumption growth.
Why the fourth quarter?
They hypothesized that investors' consumption and portfolio decisions might be more synchronized at the end of the tax year, maybe due to bonuses, tax planning, portfolio rebalancing, making that period's consumption data particularly potent for explaining returns.
An interesting behavioral or institutional story.
Indeed, that's a clever and intuitively appealing hypothesis, and the data shows something promising. In the data from 1948 to 2016, this variant actually yields a significant price of consumption risk, 1, of 1.75% per annum,
Okay, higher than before.
and a much higher cross-sectional R-squared of 60%.
Wow, 60% is pretty good.
It is. The intercept, arrow, is also much smaller and insignificant at 3.3%. This certainly suggests there might be something to that fourth quarter synchronization idea.
So maybe the timing of consumption matters a lot.
It might. However, bringing this back to our central theme and the disaster model, even this improved model still gets strongly rejected by the chi-squared statistical test in the data.
Ah, so still not a perfect fit statistically.
Correct. And our disaster model, which we'll discuss shortly, where investors are assumed to make decisions every period without assigning special importance to any specific quarter, well, it naturally struggles to fully replicate this specific empirical success of the fourth quarter variant.
Because it doesn't have that built-in year-end focus.
Exactly. It highlights a nuance that even a sophisticated disaster model might miss if it doesn't explicitly account for behavioral or institutional factors like tax year-end effects, which are not purely driven by fundamental economic shocks like disasters.
Okay, so we've laid out the puzzles. The value premium's weird behavior depending on the time period, the flat or negative beta return line, and the struggles of the consumption CAPM. If conventional models, even sophisticated ones, consistently struggle to capture these empirical realities, how does this new equilibrium model, the one incorporating disasters, manage to reconcile these persistent observations? It sounds like it's adding some incredibly complex layers to truly mirror reality.
It absolutely does, and that's precisely its strength. The model constructs a sophisticated general equilibrium production economy.
Meaning everything fits together. Production, consumption, prices. It all emerges from the model itself.
Exactly. It's a fully self-consistent system where everything from production to consumption to pricing is determined endogenously within the model itself. It has several key ingredients. First, it features a representative household with recursive utility.
Okay, what does that mean, recursive utility?
It's a way of modeling preferences that's more flexible than standard approaches. It allows you to separate how much people dislike their risk aversion from how much they want to smooth their consumption over time.
Ah, so those two things aren't locked together like in simpler models.
Right, it gives you more realism. Second, it includes heterogeneous firms, meaning firms that differ significantly in their capital levels and their specific productivity. Some are capital rich but less efficient. Others are nimble and highly productive.
Like value versus growth firms, maybe.
That's part of the intuition, yes. Crucially, these firms face asymmetric adjustment costs.
Meaning it's harder to shrink than grow.
Exactly. This implies it's significantly harder and more costly for firms to shrink their capital to scale down operations or shed assets than it is for them to expand it. And this asymmetry is particularly pronounced for value firms, which tend to have more existing, often older and less productive capital.
Okay, that sounds plausible. Harder to fire people and sell old factories than build new ones.
Precisely. And what about the central role of disasters in all of this? How are these catastrophic events woven into the very fabric of this economy? It seems to be the linchpin.
It really feels like the core innovation here.
It is. The economy is subject to aggregate productivity shocks, which include rare but severe declines. These are our disaster states, as well as subsequent recovery states.
So think the Great Depression, maybe the global financial crisis, those kinds of events.
Exactly. Think of historical events like the Great Depression, where aggregate productivity plunged dramatically and remained low for an extended period, leading to widespread economic hardship. The model carefully calibrates these disaster characteristics based on robust historical cross-country data, ensuring realism.
How rare and how bad are these disasters in the model?
For instance, the annual probability of a disaster is set at a conservative 2%, meaning, on average, once every 50 years.
Okay. Infrequent, but not impossible.
Right. And its persistence leads to an average duration of 33 months, nearly 3 years of sustained downturn. The model's impulse response for consumption, meaning how much consumption drops when a disaster hits, shows about a 13.9% decline in the short term and 9% in the long term.
And how does that compare to reality?
What's compelling here is that this is actually quite conservative compared to the 29% and 14% observed in actual historical data from major crises.
So they're not exaggerating the disasters to make the model work.
Not at all. This conservative calibration makes the model's success in explaining the puzzles even more compelling, as it's not relying on exaggerated, unrealistic disaster impacts. It's working with plausible, even conservative, real-world parameters.
Fascinating. So how do these complex elements, particularly those asymmetric adjustment costs and the disaster states, combine to explain the value premium? It's been such a stubborn puzzle, so how does this model finally crack it?
This is where it gets really interesting and elegantly connects the dots. Our model shows that value firms,
The ones with high book-to-market, lots of existing capital.
right, those firms, which typically have more existing, often less productive capital, are particularly burdened due to those asymmetric adjustment costs we just discussed.
Harder to shrink.
Exactly. They find it significantly harder and much more costly to reduce their capital in a disaster state compared to more agile, typically newer growth firms.
Growth firms can adapt more easily.
That's the idea. Growth firms, being leaner, more focused on future opportunities, and with less legacy capital, can adapt more easily, shedding unproductive assets or pivoting their strategies with greater flexibility when disaster strikes.
Okay, makes sense.
Consequently, value firms are much more exposed to disaster risk.
Okay. This is key.
It is. When a severe economy-wide disaster hits, the representative household's marginal utility of consumption skyrockets.
Meaning every dollar becomes way more valuable because times are so tough.
Precisely. Every dollar of consumption becomes incredibly valuable for survival, protecting your family, or just getting by. In these dire times, value firms, being more vulnerable, less flexible, and burdened by unproductive capital, get hit disproportionately harder in terms of their cash flows and profitability.
They suffer more in the really bad states of the world.
Exactly. This higher, more acute exposure to truly disastrous times means they must offer a higher expected return in normal, non-disaster times to compensate investors for bearing that catastrophic systematic risk.
So the value premium is essentially compensation for this hidden disaster risk.
That's the core mechanism. This mechanism, while building on prior work on asymmetric adjustment costs, is fundamentally turbocharged by the extreme nature of disasters. It's not just about regular recessions, it's about those rare, severe economic earthquakes that amplify existing firm-level vulnerabilities and ultimately drive the sizable value premium we observe.
So the model can generate a value premium, which is a big step. But the even more impressive part is how it explains the CAPM's apparent failure in normal times, that post-1963 period we talked about, and its much better performance when disasters are present, like the full sample, including the Great Depression. How does it bridge that gap?
Right. This seems to be the very core of the CPM strikes back premise.
It does.
A crucial point here is understanding the pricing kernel. You can think of the pricing kernel as a sort of universal discount factor that tells us how much investors value a dollar received in different states of the world.
Okay, how much a future dollar is worth today, depending on whether things are good or bad then.
Exactly. It's a crucial theoretical concept that essentially discounts future cash flows based not just on time, but on their riskiness, and critically, when you receive them, especially whether you receive them in good times or truly bad, disastrous times.
Got it.
In our model, disaster risk induces strong nonlinearity in this pricing kernel.
Meaning the value of a dollar changes dramatically, not smoothly, when a disaster hits.
Precisely. The linear CAPM, which implicitly assumes a linear relationship between the pricing kernel and market returns, is inherently a poor empirical proxy for it because it simply cannot capture these extreme nonlinear shifts in investor valuation during a crisis.
So CAPM is too simple, too linear for a world with disasters.
That's the argument. So, in samples without realized disasters, like the post-1963 period, the estimated market beta from linear regressions only captures the weak covariation of the value minus growth return with the market in normal, non-extreme times.
It only sees the calm weather, not the hurricanes.
Well put. Because those big correlated swings aren't happening within that specific historical window, the linear regression sees a flat line. It fundamentally misses the higher but unrealized exposure of value stocks to potential disaster risks.
The risk is there, lurking, but the data doesn't show it yet.
Exactly. Therefore, the CAPM appears to fail, not because the underlying risk-return relationship is absent, but because our linear measurement tool is inadequate for a nonlinear world where extreme events, even if latent, still shape expectations and true risk.
Okay, but then what happens when disasters are in the sample?
However, in samples with realized disasters, like the full sample, including the Great Depression, those extreme events create large, visible covariation between value minus growth returns and the overall market. Those powerful observations pull the regression line.
The hurricanes hit, and you see how strongly the ship rocks.
Precisely. The estimated market beta then provides a much better, though still imperfect, account for this larger covariation because the extreme observations reveal the true underlying sensitivity. So, the CAPM appears to perform much better.
Because the data finally includes the events that reveal the true risk.
Exactly. The model's simulated data perfectly mirrored the real-world data we discussed earlier, showing the value minus growth return covering strongly with market excess return in disaster samples, but much less so in no disaster samples. It's a compelling illustration that the CAPM isn't broken. Our empirical methods, especially in calm periods, often just don't give it enough data to show its true underlying strength when faced with these nonlinear risks.
And how does this same framework, this distinction between true and estimated betas and the role of disasters, shed light on the flat beta-return relation, that beta anomaly we discussed earlier, where higher risk doesn't seem to be rewarded?
It applies directly. This also comes back to the crucial distinction between the true dynamic beta and the empirically estimated beta.
The measurement error story again.
Yes.
Yeah.
The model's simulations confirm that if you were to sort stocks based on their true underlying market beta, their actual real-time exposure to aggregate risk, you would yield large, positive average return spreads across deciles.
So in the model's true world, higher beta does mean higher return.
Correct. The fundamental economic relationship holds. More true systematic risk means more true expected return. However, the empirically estimated pre-ranking beta, for instance, calculated from prior 60-month rolling windows.
The one we actually use in practice.
Right. That one is fraught with significant measurement errors. It's essentially a historical average over a rolling window, whereas the true beta is a dynamic reflection of constantly changing aggregate and firm-specific conditions.
Is laggy and smoothed.
Exactly. The model shows that the true beta often mean reverts quickly within that window, meaning it fluctuates, leading to a weak, only 2.84% positive in disaster samples, or even negative, -5.43% in no disaster samples, correlation with the more static rolling beta.
So the thing we measure might be barely related or even inversely related to the thing we want to measure, especially in normal times.
That's the startling implication. This inherent noise or imprecision in the empirically observed beta can completely obscure the true positive relationship between systematic risk and expected return. This makes the observed beta-return relationship appear flat in empirical tests, even though the underlying economic theory holds in the model.
It's a powerful demonstration of how measurement error can completely mask an underlying truth, making it look like an anomaly when it's truly a mismeasurement.
Exactly. It suggests we need to be very careful about interpreting results based on these rolling window betas.
Finally, let's circle back to the consumption CAPM. This is a model where a nonlinear consumption-based pricing relationship holds exactly by construction within the model's theoretical world. The model is a consumption-based model at its core. So how can it still show the empirical failure of its standard tests in the real world? This feels like a true paradox. The model should validate the theory, but it shows it failing.
Right. Seems contradictory at first glance. Bringing this back to the broader context, the model clearly illustrates that aggregate consumption growth as we typically measure it.
Like the quarterly GDP numbers for consumption.
Yeah, that kind of aggregate data. It's a very poor proxy for the true nonlinear pricing kernel that arises from recursive utility and disaster shocks.
Why is it such a poor proxy?
Remember, the true pricing kernel depends not just on contemporaneous consumption growth, but also on a complex, nonlinear function of the investor's anticipated future utility. It's not just about what you're consuming now, but what you expect to consume in the future, and critically, how bad things might get.
It's forward-looking and sensitive to potential bad states.
Exactly. Investors anticipate future pain, not just react to present changes. When a disaster shock hits, the true pricing kernel spikes immediately and dramatically.
Because people freak out about the future.
Essentially, yes. This reflects the investor's immediate anticipation of multiple years of extremely bad times with potentially severe drops in future consumption. The market, being forward-looking, immediately prices in that future pain.
Okay, but what does actual consumption do?
However, consumers, being human, tend to smooth their consumption over time. We try to maintain our lifestyles.
Yeah, you don't immediately cut your spending by 30% the day a crisis hits.
Right. While real investment might fall immediately, aggregate consumption only drops cumulatively and gradually over multiple years as people try to maintain their spending habits for as long as possible, maybe by dipping into savings or borrowing.
So there's a lag in smoothing an actual consumption compared to the immediate market reaction or pricing kernel reaction.
Exactly. Analogously, when the economy switches from a disaster to a recovery state, the pricing kernel drops and the market return spikes up immediately, with real investment increasing right away. But consumption only rises gradually. People don't instantly start spending like crazy again.
So what does this all mean for why the CAPM, as traditionally tested using aggregate consumption growth, falls short, even when a consumption-based theory is fundamentally true in the underlying economy?
It means the timing is all off. The market excess return, being forward-looking and reacting quickly, much like the true pricing kernel and investment decisions, is far more responsive to disaster shocks than smooth consumption growth.
The market moves first, consumption follows slowly.
That's a good way to put it. The paper highlights this by showing that the R-squared of the pricing kernel regressed on aggregate consumption growth is only 0.24% in disaster samples.
Almost nothing.
Remarkably low, and much less than its R-squared with market excess returns. This fundamental disconnect between the immediate, forward-looking, and nonlinear nature of the true pricing kernel and the smooth, gradual, and linear nature of aggregate consumption growth explains why the standard linearized consumption CAPM, which uses consumption growth as a simplified linear proxy for the pricing kernel, performs so poorly empirically.
It's simply trying to force a square peg into a round hole, using the wrong proxy.
Precisely. The theory itself isn't wrong within the model. It's our empirical application of it with simplified proxies that leads to its apparent failure. And the proof is in the pudding. The model's performance improved dramatically when the true pricing kernel from the model was used in the CAPM tests.
Something we can't observe directly in the real world, but they can in their simulation.
Exactly. When they used the true kernel, they failed to reject the model and achieved R-squared values as high as 89% in disaster samples.
Wow. That's a huge difference, from 2% to 89%.
It's a powerful testament. The elegant consumption-based theory holds within the model. We just need better ways to test it that respect its underlying complexity and nonlinearity, or better proxies for that true pricing kernel. Using smooth aggregate consumption just doesn't cut it.
This deep dive truly makes you rethink some long-held conclusions in finance. Instead of assuming our foundational financial theories like CAPM or CAPM are just plain wrong.
Which has been a common narrative for decades regarding these anomalies.
Right. This groundbreaking research suggests our empirical tests might simply be too simplistic, too linear, or too short-sighted for the complex, disaster-prone reality of modern economies. It's a profound reframe, suggesting we might have been blaming the map when the compass was just a bit off, or maybe we weren't reading it right in stormy weather.
That's a great way to put it. What's truly remarkable here is the model's impressive ability to quantitatively replicate all three major stylized facts simultaneously within a single, consistent general equilibrium framework that endogenously determines consumption and prices.
It ties it all together.
Yes, this is a unified explanation, which is rare and incredibly valuable in financial economics. It explains the conditional failure and success of the CAPM in explaining the value premium that it works when disasters are in the data but fails without them. It explains the flat beta return relation, what we call the beta anomaly, due to severe measurement errors in estimated beta. And it explains the poor empirical performance of the standard consumption CAPM due to its misspecification as a linear model of a fundamentally nonlinear process using the wrong proxy. This is a huge leap forward in bridging the gap between theory and observed market behavior.
So for investors, financial analysts, or really anyone interested in understanding market behavior, what's the one core shift in how I should think about risk and return after today's deep dive? What's the aha moment I should carry with me beyond the academic details?
That's a great question. I think the biggest takeaway, and this is crucial for anyone making financial decisions, is this. Most of our standard models assume a largely linear, calm, and predictable world, maybe implicitly.
Business as usual.
Right. But the real market has earthquakes, rare but incredibly impactful disaster events. You need to stop looking at historical averages from only normal periods as your sole guide and start explicitly asking, how exposed is this asset or this portfolio to a true catastrophic market-wide downturn?
Thinking about the tail risk, the really bad scenarios.
Exactly. Even if it hasn't happened in my recent data window of the last 10, 20, or even 50 years, the potential for such an event is what fundamentally shapes an asset's true risk and its required long-term return. Don't just measure beta over the last 60 months, anticipate disaster, because that potential is priced in, even if unseen in calm times.
That latent risk is always there.
A crucial point here is that when interpreting financial data, we need to be acutely aware of rare but extreme outlier events like disasters, because they fundamentally shape long-term relationships and risk exposures in ways that tranquil periods simply cannot. Relying solely on data from normal periods, or employing simplified linear models that don't account for nonlinearity and sudden regime shifts, can lead us to profoundly incorrect conclusions about fundamental economic relationships.
Makes sense. Ignoring the extremes gives you a skewed picture.
Totally. The paper's comparative statics further illustrate this, showing that increasing the disaster size or its persistence significantly exacerbates the CAPM's empirical failure in normal times. It makes the linear approximation even worse. Key adjustment cost parameters, like those that govern a firm's flexibility to change its capital, A and C in their notation.
How easy or hard it is to shrink.
Right. They significantly affect the value premium by altering firms' resilience or lack thereof during disasters. More inflexible firms, typically value firms, have higher disaster risk and thus higher premiums.
It connects the firm characteristics to the disaster risk.
Exactly. Even the liquidation value parameter, which determines what shareholders receive if a firm exits the market, significantly impacts risk premiums by providing an abandonment option that acts as a form of insurance against disaster risk, especially for vulnerable value firms.
So even the details of bankruptcy or liquidation matter for disaster risk.
They do, according to the model. These are all subtle but powerful forces at play, driven by how firms cope or fail to cope with disasters.
So bringing this back to the broader context, what's the implication for future research or practice?
Well, it suggests that complex, nonlinear economic phenomena, particularly rare disasters, demand equally sophisticated nonlinear theoretical models and carefully designed empirical approaches to truly understand and price risk and return accurately. We simply can't just slap a linear regression on a fundamentally nonlinear world and expect it to tell the whole story.
We need tools that match the complexity of the world.
Precisely. We need to build models that explicitly account for the entire spectrum of economic possibilities, especially the extremes, and empirical methods that can handle nonlinearity and potential mismeasurement.
That's a truly provocative thought for our listeners to ponder.
Yeah.
Could many other anomalies and unexplained phenomena in finance, the ones that keep researchers busy and investors perplexed, also be symptoms of measurement errors or misspecified linear tests trying to capture a fundamentally nonlinear world rather than inherent flaws in the underlying economic intuition?
It's a definite possibility. It makes you wonder how many puzzles are simply a matter of perspective, waiting for us to choose the right lens or perhaps develop a better one. Maybe the world isn't as anomalous as our simple models make it seem.
Maybe the anomalies are telling us more about our models than about the market itself.
Yeah.
Hashtags, tag, outro. Today, we've taken a deep dive into some of the most persistent puzzles in financial economics. We've seen how incorporating rare but incredibly impactful disasters into a sophisticated equilibrium model can help us understand why the CAPM sometimes works and sometimes doesn't for the value premium.
Depending on whether those disasters are in the data sample.
Right. Why beta seems flat when it should be rewarded.
Likely due to measurement error obscuring the true relationship.
And why the elegant consumption CAPM struggles, despite its theoretical elegance.
Because aggregate consumption is just too smooth and lagged to capture the real forward-looking risk priced by the market.
It's a powerful reminder that the market's true nature is often far more complex and nonlinear than our simplified observations or linear models suggest.
Absolutely. The world isn't always neat and linear.
So next time you hear about another market anomaly, something that seems to defy logic or theory, ask yourself, is it truly an anomaly, a fundamental flaw in our understanding? Or are we just looking at it through the wrong lens, missing the profound, often hidden impact of those rare but potent economic shifts and the true dynamic nature of risk?
A very good question to keep in mind. Is it the market or is it our measurement?
Food for thought until our next deep dive.